Welcome to RBC's Markets in Motion podcast, recorded April 24th, 2026. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, the three things that stuck out to us in our review of earnings calls last week included outlooks that emphasize resiliency but contained a dose of caution, the conversation on Iran war impacts present and future getting underway, and descriptions of cautious but stable consumers. Second, with U.S. equities breaking out to a new 2026 high relative to non-U.S. equities, we note that valuations suggest there's room for this trade to run and that weak earnings revisions breadth is not a problem unique to the U.S. Third, funds flows are shifting back to financials and growth, which we think makes sense from a valuation and earnings growth perspective. If you'd like to hear more, here's another 5 minutes. Takeaway number one, what we've learned from earnings. Resilient outlooks with a dose of caution, conversation on war impacts getting underway, and cautious but stable consumers. We've previously described financial markets as being in a discovery process when it comes to how the situation in the Middle East is impacting U.S. public companies and will do so in the future. Last week was an important one in 1Q26 reporting season as we got a diverse set of companies in terms of sector representation. We're eager to learn more this week when 168 S&P 500 companies are scheduled to report. Here's what jumped out from last week. On the broader macro outlook, companies generally emphasized the resilience of their businesses. Some noted that demand was steady or they weren't seeing material impacts from the war yet, while others highlighted the strength of the AI data center theme. Still, a sense of caution came through. Some described the macro as uncertain and dynamic, while one noted they had seen an increase in concerns about inflation from their customers. The ongoing impacts of high interest rates and inflation on housing and autos were referenced. A few noted they were maintaining guidance while referring to their desire to stay conservative. One company noted, absent the uncertainty in economic conditions related to the Iran conflict, we would have raised our full year guidance based on strong 1Q results. Digging deeper into the Iran war. While some companies noted they weren't seeing adverse impacts due to the war, others discussed some that they were seeing or anticipated seeing in the future. One industrial company quantified a modest revenue impact, while another noted they had experienced project delays in the region. Meanwhile, one software company reported a headwind from deal closings in the region. Other topics discussed included higher jet fuel and diesel costs, future impacts to air travel demand, facility shutdowns, the use of alternative supply routes, and the use of hedges and other mitigation tools. Regarding the potential duration of the conflict, some noted it was difficult to predict, while a few indicated they were baking in a continuation of the conflict through 2Q26 or summer. Other thoughts on timing included one company noting they were hopeful the flow of materials would return in a few weeks, while an airline noted they had visibility for 4 to 5 weeks, and a software company observed there could be energy impacts in Europe if the strait stayed closed for another few weeks. A few companies highlighted their ability to pass on or recoup higher costs. Inventory is another topic we're keeping an eye on. One consumer company noted there might have been some pull forward by retailers, but said they didn't think consumers were pantry loading. Another company also noted they had not experienced pull forward in demand. Consumers are considered cautious but stable. This was a phrase used by one consumer company, which we think did a good job of summarizing the overall vibe. Another company described demand as measured and healthy, another used the term steady, and yet another noted no discernible shift in behavior. An airline noted they were not seeing demand destruction but thought it was wise to prepare for it. Several companies noted the benefit of higher tax refunds, but one added that consumers were using those dollars cautiously. K-shaped consumer dynamics were referenced by several companies. Affordability and inflation and interest rate pressures taking a toll were noted. There's been a lot of conversation about the resiliency of the earnings backdrop in the U.S., which we and others have attributed in part to strength of the AI theme and its insulation from the conflict. When it comes to the rest of the market, what we read last week continues to help us understand why we haven't seen significant deterioration in 2026 EPS growth forecast broadly. What we read makes us think the real risk may ultimately lie in 2027 numbers, but it's premature to make that call. Moving on to takeaway number 2. 3 things we're watching on U.S. equities versus non-U.S. equities. U.S. equities have just hit a new 2026 high relative to non-U.S. in terms of performance. The U.S. surged relative to non-U.S. in the early days of the war, then moved sideways throughout much of March, with the U.S. hanging on to the leadership it accrued but not adding to it. That all changed last week with the U.S. breaking out to a new high versus non-U.S. Growth also continued to outperform value, while the biggest market cap names continued to outperform the rest of the S&P. We think renewed nervousness about the war and strength of AI-related earnings relative to the rest of the market fueled the latest move in what has been perceived as one big safe haven trade, and we suspect that will endure as long as investors remain concerned about the war's duration and ripple effects. We are keeping a close eye on U.S. non-U.S. valuations. Our data currently shows that U.S. non-U.S. valuations are in line with a 5-year post-COVID average using PE and is a bit above its 20-year average, but is nowhere close to past extremes. This is important since reasonable valuations in U.S. versus non-U.S. were something we believe helped the U.S. safety trade get started after the war began, and that a return to extreme levels on these charts could help us know when this trade is getting overdone. It's also worth noting earnings sentiment has been weakening globally. With the U.S. breaking out to a new high versus non-U.S. in terms of performance, and the rate of upward EPS estimate revisions weakening in the S&P 500, it's worth noting that we are also seeing a weakening of earnings sentiment, the rate of upward revisions, in other global developed market regions and major countries. In other words, the poor earnings breadth in the U.S., aside from the mega cap growth AI-related names, is not a unique problem geographically speaking. And we'll wrap up quickly with takeaway number 3. The other big things that jumped out to us this week are shifts in sector and style flows. In our review of EPFR's Global Developed Markets fund flow data, we are now seeing outflows from all defensive sectors, utilities, REITs, and healthcare. Otherwise, trends that jump out include deterioration in energy and industrial flows alongside improvement in financials. In terms of style, growth flows are improving, getting less negative, while value flows are deteriorating. We see these as healthy undercurrents for the equity market given the valuation improvements seen for financials recently, the superior earnings trends of megacap growth, and the extremely expensive valuations in place for industrials. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.